A concept that's going to be newish to you in intermediate accounting is the concept of discontinued operations. Elements of our business that we don't intend to have operate for the entirety of the upcoming business year. And the rules of GAAP state that something should be considered a discontinued operation if you are disposing of it, I mean, selling it to somebody else, deciding that you're going to stop doing, liquidating all the assets, whatever. You abandon it during the upcoming reporting period. You just, we're done with this. We're not doing it anymore. Or you are planning at the end of the time that you're reporting and into the next period to liquidate it. Because if you do that, if it's the end of, say, 2025 and you started the liquidation process, but you're not going to finish till 2026, what you need to do is all the assets held by that discontinued operation, you declare as for sale assets, which makes them current assets. And GAAP says that you have to adjust them to their current market value. So an entity element is discontinued, whether you've already gotten rid of it in some kind of formal procedure, you just completely abandon it, or you are in the process of removing it when the period that you're reporting for ends. When you do so, there's three big components that you have to report, depending on the situation, for your discontinued operations. And one, if there was any operating from that element that's now being discontinued during the period, it's either going to generate some kind of income or more probably incur a loss during the period. Well, you still have to factor that into your company's overall profitability. So any income or loss that was resulted from the operations of a discontinued segment, unit, or group gets reported. If you are in the process of liquidating, you have to declare all of the assets associated with that discontinued segment as for sale, current assets, and GAAP requires you to revalue them to their fair value. And if that's different from what you were carrying them on the books for before you decided that you were going to discontinue the segment, you're going to have some kind of gain or loss on revaluation. You need to report that. And if you did get rid of some or all of those assets during the period, well, then you probably incurred a gain or loss on asset sale. So the three elements are basically how profitable or unprofitable was the segment, and in here, what type of gains or losses are we incurring collectively between these two on the disposition of all the assets that were used by that discontinued segment. And when you report all of these, you report them net of tax. Basically, you account for what your going tax rate is and how these elements, the income, gains, or losses, would have affected the amount of tax that you had to pay. So let's put this into practice on the next slide. We're going to be Choo Incorporated. Across everything that we did for continued operations, discontinued operations, the entirety of our whole entire business, any others, we had $30 million of pre-tax income for the year. We have a toy car division, which we've decided that we are not going to do anymore. We're disposing of this toy car division. And this is the information that we have to work with. While it was $30 million for everything in the company, $4 million of that came from this toy car division that we are disposing of. Apparently, we were in the process of liquidating all these assets, and the carrying value that they were at when they were being carried at the GAAP historical cost basis was $350,000 higher than the fair value we had to mark them down to when we declared this to be something that we were going to discontinue. So we had a $350,000 loss on the revaluation of our assets. And since we have to report things net of tax, we have to know what our tax rate is. Let's assume that Choo Choo has a 35% tax rate. Well, how does this break down? Well, if we had 30 million overall in pre-tax income and 4 million of it came from the discontinued operation, well, then we know the other 26 million had to come from income that was part of our continuing business model. That 26 million that we had, if we multiply it by our 35% tax rate, we see that we had to pay $9.1 million in taxes on our income from continuing operations during the period. What about the 4 million that came from this toy car division that we're discontinuing? Well, we'd report that income net of tax as 2.6 million. Why such a lower number? Because this is $4 million of taxable profit that we still had during this period, even though we're discontinuing the toy car division. And 35% of 4 million is 1.4 million. So what we're saying here is net of tax, this only increased our company's overall profitability by 2.6 million because we had to pay $1.4 million in taxes on the $4 million of income that came from our discontinued operation. And then for the revaluation of our assets over here, we would have incurred a loss of $350,000 writing them down. And that loss would have been filed on our taxes. Losses are tax deductible, which means this would have reduced our taxable income by 350,000. And we wouldn't have to pay the 35% tax rate on that $350,000 of income that we got to write off because of this revaluation loss. And 35% of 350,000 shows that we saved $122,500 on our taxes. So that $350,000 loss at face value really only decreased our company's overall profitability by 227,500 because it allowed us to save a significant chunk on our taxes during the period. So, all in all, this is what the discontinued operations section would look like on a multi-step income statement. You would have your income from continuing operations before tax. We knew that to be 26 million. We calculated the taxes we would have had to pay on that 26 million is 9.1 million, leading us to $16.9 million of income that we had from continuing operations. And then the after-tax effect of the two elements of the toy car division that we discontinued is that the income from that division increased our overall profitability by 2.6 million, while the loss on the remeasurement or revaluation of the assets of that division decreased our income by 227,500. The offset of those two is 2,372,500. So we made 16.9 million from things we're going to continue to do during the next period. We made 2.3725 million from this thing that we're not going to continue to do, the toy car division. All in all, company wide, our net income was 19,272,500, and now it's broken down into what you can expect to generate again during the next period and what portion of that overall total came from something we're not going to do anymore. In the notes to a financial statement, when you discontinue an operation, you need to provide some pretty significant information about why you are discontinuing that operation, when it's going to be discontinued, etc. And I'm not going to go through all the different topics in here, but this is very real from Adidas when they got rid of the Reebok brand that they divested of. They noticed that it was approved in this case. They are reporting it as a discontinued operation, and they're currently held for sale until the resolution of the sale of Reebok to somebody else or just getting rid of it is completed. And that was at the end of 2021 over here. And then in 2022, that's when it was sold. Went into effect on March 1st, and how they got paid for this, etc. Also down here, it gives a little information about how they determine the fair value of the assets when they revalue. So I'm not going to go crazy making you have a bunch of notes about your discontinued operation in the financial statement, but in real actual practice, absolutely. You got to tell the timing of how you're going to discontinue things. If there's any revaluation, you have to tell how you arrived at that number, etc. So we talked about net income. We've talked about how discontinued operations work. Let's talk about something else that's probably going to be pretty new to you, and that is a non-controlling interest. Net income is the bottom line profitability of our company. We'll call it consolidated net income. It's all the income that we have from all of our sources. And in a world where the only people that are entitled to that income are your shareholders, they would get it every crack of your net income. But sometimes that's not the case. Companies buy out other companies all the time. It's part of the business world. A lot of people get into business with the goal of selling their company to somebody else for a much higher price. When that happens, it's not completely uncommon for the original owners to hold on to an incredibly small portion of the equity in that company. Example that I use is at the time Fruit of the Loom was sold to Berkshire Hathaway, the original owners of Fruit of the Loom held on to 10% of the business. Well, now, if that is the case going on over here, shareholders of Berkshire Hathaway wouldn't be entitled to every single penny of profitability they made during the period. Some of it would be entitled to what they call the non-controlling interest, those former owners. So when you have bottom line net income, but you have a non-controlling interest, you have to report in there what portion of the total consolidated net income you are reporting can go to your shareholders and what portion is attributable to those non-controlling interests. How you manage this in accounting is instead of keeping separate sets of books for the non-controlling interest, you just put everything together. Like you want to consolidate every single penny that came from that subdivision, that segment that has a non-controlling interest into your overall consolidated financials. So all the revenues that came from it, all the expenses incurred, use all of that information to measure out your profitability company-wide. And then at the end, you reverse out the portion that goes to the non-controlling interest. The other thing that has to be on an income statement is your EPS, your earnings per share. And I talked about this previously in the slide, but EPS is a better measure for potential investors of how much income they could potentially be entitled to if they bought a share of your stock. And if you break it down on a per share basis, it puts the value of your stock to a potential investor into better perspective. So at the bottom of an income statement, when you report your EPS, you have to report it in different ways. You report your total EPS, like of all the earnings that you had on the books against the actual amount of number of shares that are outstanding right now. What was your earnings per share? But you also, firstly, need to break that down into what portion of it came from continuing operations, what portion came from discontinued operations. But if you have something going on in your business that could radically change the number of shares outstanding, dilute everybody's ownership, you also have to report your EPS on a diluted basis. So, what are some things that could possibly cause this big chunk of shares to go out into the market? Employee stock options. It's a common perk for people that work there to be able to buy shares or they get shares as bonuses, etc. So, if you have some stock options out there where employees are totally entitled to buy your shares right now, but they haven't yet. You need to factor that into your diluted EPS. Convertible bonds. You have a big outstanding bond. If you don't want to pay all the cash when that bond becomes mature, you can instead issue shares of common stock to the person instead. So diluted EPS is basically figuring out what your EPS would be if all of these elements in here that could cause a massive outflow of stock into the market came to fruition. And now it would greatly increase the number of shares that you had outstanding.